let's do something with chapter 4. What do you think, guys? Have you noticed that this stuff is sort of a review of chapters 1 and 2? Okay? A lot of it is. What are we going to use an income statement for? I don't know. Compare our budget to our actual, right? Evaluate past performance. Basis for predicting future performance. And what we really want to do is predict what? If I'm an investor, or I'm a creditor, right? Loan money, which is still investing, buy their bonds or, buy their stock. What do I want to know? Future what? Cash flows and how risky they are and when they're going to happen, right? If I'm going to do the present value of something, what do I need to know? How much cash flow in the future, when, and how your timing of it, and how uncertain it is, because that's going to determine my discount rate, and then I can value those future cash flow standards. That's how we're going to value stock. That's how we value bonds. You already know that for bonds, huh? We did it 101. We do it again with debt in 212. More complex. Okay, a little bit. Okay, it's still pretty easy. So we value stock exactly the same way. Same concept. We value a new employee the same way. We value a new truck the same way. What are you willing to pay the new employee? What are they going to generate for you in cash flows? That's it. You get some of your cash flows. I used to get 55% of what I billed when I was with Wire Every Cost. 55%. What did I want? A real high billing rate and lots of hours billed. What do you think? Because I got 55% of it. Guess what the partners wanted? A real high billing rate, right? And they got 45%. Did they want the billing rate so high that nobody would hire us? No. Did they want it to be a real bargain for our clients? No. We used to get complaints. I got complaints from clients all the time. Your billing rate's higher than anybody in town, except for the big 6 firms or big 8 firms in those days, right? They were higher than us. But you're higher than everybody else in town. Yeah. Well, I think you should charge us less. I said, well, you don't have to use us. The other firms charge less. Why don't you use them? And they laughed. Said, well, because it doesn't take you as long, and because the work is higher quality. So, I said, you mean you end up paying less for a better quality product? We should raise our rates, shouldn't we? And they laughed. Said, how do you get a high billing rate? No, what the hell are you doing? Okay. And do it. So what do we have to be doing this testing quizzes? Know what you're doing and do it. This was $100 an hour was my billing rate. Not quite 40 years ago. 37. You guys are aware there's been some inflation, right? Yeah. Okay. When you're at bill 3,000 an hour. And okay. It's going to destroy my health, destroy my marriage. The problem is there's always more work than you possibly do. Just sitting here. It's horrible. Okay, anyway. So don't do that. Predicting future performance risk and uncertainty. We got it. It's right there, isn't it? If you remember that you're just trying to calculate the present value of your cash flow, the answer is 350. The past performance is for evaluating employees. Okay, anyway. Limitations? We leave all kinds of stuff out of the financial statements that is really important, right? How healthy is the president? You ever see that in a financial statement? That's a really critical thing. How good is your marketing program that you're currently running, right? And the one you plan to run. That's not in there. What's in there? Mostly historical stuff, but what's the real value in historical stuff? You can predict the future rate, right? What if I told you this? What if I told you right now my salary is $50,000? Right now this year, what is this year, 2015? What if I told you in 2015 I make $50,000? Okay. Or what if I told you my salary was $300,000? It's neither one of those, okay? All right? Okay, it's much less than either one. Okay, anyway, I hope that's a joke. Okay, anyway, so 2016, how much am I going to make?
50 or a little more.
Yeah, if it's 50, you might think, James, the college professor, he's going to make $50,000 $70,100, right? College professor of Bellarmine, that's how big our raises are. Or if it's this one, which wouldn't be at Bellarmine, you're making this much, right? You could predict the future, couldn't you? But are these numbers, that's a joke too. Those numbers, though, mean something completely different. So what if a company made 50,000 net income this year that made 300? Would it help you predict the future? Yeah. Is it a very good predictor? No. Because could something go wrong and it's nowhere near as much? Could something go right and it's far more? Do you have to know other things? Yeah. But is it a predictor? Yes. That's all we got, guys. What we have are these estimated financial statements that do what? Give somebody some sort of insight into what happened in the past and some ability to predict what's going to happen in the future. Is it very exact? Of course not. That's why it's a profession, right? That's why you make money, okay? Because you're dealing with so much uncertainty. What are they? So they admit all kinds of stuff. Numbers are different for different accounting methods. You have to know the difference between LIFO and FIFO. Oh man, it can really impact the income, or maybe not. When would LIFO versus FIFO impact the income a lot? When you have a lot of inventory and it's not turning very fast. What if you're using LIFO and FIFO when it would have very little impact? The inventory is turning really fast, turning over all the time. It's all the cost of goods sold anyway, and you have very little inventory, right? That's it. What if you're a service-only business? You only sell services. Your inventory doesn't matter. Inventory method doesn't matter. Got the idea? So you need to realize what the differences are when we get done with these courses, right? Hopefully, right? When you get out of school, what the differences are and how it would impact what's reflected in the financial statements, and then how it would impact the decisions you're going to make running the company, right? Making the shareholders more wealthy. And no sure some of that with you, right? That's basically how it works. Okay, good. And then all kinds of judgment in there. And by the way, where there's judgment, is there opportunity for income manipulation? Do they talk about the quality of earnings? What's the deal? I'm estimating, what are the big estimates you can think of in financial statements? On the balance sheet and the income statement. What are the big estimates? Because of course the balance sheet and income statement impact each other. Give me one. I did it in principles today. We're on cash, sales, receivables chapter. Chapter 5. Bad debt expense. It's an estimate, isn't it? And what's the other side of that estimate? That's the one that's on the income statement. Allowance for doubtful accounts. That's the one that's on the balance sheet. Okay, so you can manipulate that, can't you? Okay? You want to make the best estimate you can. Absolutely. You think about this. What's the deal, guys? Okay, I'm estimating here, right? What's going to happen? If I make my allowance too small, what have I overstated? Tendency is to try to make things look better than they really are. That's if you're a company that's trying to make a profit, right? Look profitable. Build your stock price up. What if your company is trying to minimize your taxes? Say there's one owner, they own 100% of the stock. Where are they lying to? So it's okay, right? Really, they're lying probably to the IRS. What's their motivation going to be? Make things look as bad as possible. So it depends on what the motivation is of the company, right? If they're publicly held, what is always their motivation? Look as good as possible to build the stock price, right? So they might have a bias, or they might intentionally misstate the financial statements fraudulent, right? Okay? They might overstate income. How can you overstate income? Overstate revenues, or understate expenses. Nothing to it, right? Okay? Really? And so in the case of allowance for doubtful accounts, what if it's a divorce proceeding going on? One spouse owns, both spouses own the company, right? Jointly, right? One spouse runs it, the other one does not, but they both own the company. There's going to be a divorce. What are they motivated to do, the one that runs the company? Make it look like it is a real loser, right? They might be overstating expenses and understating revenues too. Which, by the way, let's see what this does. If you record too small a bad debt expense, what happens? It should be $200,000. You put in $100,000, small. What do you think? What have you done? You have understated your expenses. Overstated net income. Which overstates equity. Oh, remember, I had to do this in principle. It's valuable, isn't it? And what else is screwed up, of course? Yeah, are the assets overstated? Where the allowance for doubtful accounts is. If your bad debt expense is 100,000 too low, what's wrong with your allowance? It's 100,000 too low also, right? You didn't debit bad debt expense and credit allowance. So take this beyond being able to do the journal entries. By the way, you guys did pretty good when I gave you straightforward journal entries, didn't you? On the quiz. And you did horrible when I gave you ones where you actually had to look at it and compute them and think about it. True? How'd you do on the first question on that quiz, the first number, the first problem? It was a mess. How'd you do on the one where I asked you to do adjusting journal entries and a closing entry? Great on the adjusting entries, then you don't know how to close the books. Wow, really? I think you do know how to close the books. I think you can. Right? And I bet you could figure out those adjusting journal entries when you try to do it again too, couldn't you? Why didn't you do it when you were getting points for it? That's what I want you to ask yourself. Why couldn't I do it under pressure? Big deal. How many points do you have to have in here to get an A? 80%? A minus 75? Can you get 3/4 of the points on one of these quizzes? Sure you can. You just relax. You don't have to get 100, okay? And you don't have to on the CPA exam, and trust me, you don't have to when you go to work either. You don't have to have everything perfect. Nobody ever gets that. There's not time for it. Okay. Now, something. Real. No wonder I'm open so many. All right, anyway. Okay. So earnings management, two things. There's smoothing and there's big back. Think about it. What's smoothing? One of the ways we measure riskiness of companies is how much variability they have in their returns. So we're going to do that when we do the weighted average cost of capital asset pricing model. It's the variability of their returns. So just think about this. If you put let's say you take 100,000 and you put it in investment, right? You can choose between two companies. One, they make about the same amount of money every year, but gradually increasing. So, 1 year, their earnings per share is $1.10, the next year it's $1.15, then it goes to $1.20. And it just seems to always go up, right? Very rarely down. If it goes down, almost nothing. If it goes up, not much, but it almost always goes up. Very stable, right? Versus you got another company that 1 year has $2 earnings per share, and then a loss of $1 per share, and then $3 earnings per share, and then a loss of $2 a share. Got the idea? Bouncing all over the place. Which one would seem more risky to you? You're investing your money. What if you want to sell the stock? What's happening to the one whose earnings are bouncing up and down? Stock value's going up and down too. What's happening to the company that's kind of stable? Doesn't change much, but it's going up, isn't it? So it's pretty stable, which is less risky probably. The one that's more stable. Might people be motivated to smooth their earnings? This year I have more income. Right? I'm the company that's really bouncing around. This year I have more income than I really need to tell the market about. What could I do? Hold some back. How would you do that? Fail to record some revenues that you've earned this year. Wait till next year. Reduce revenues. They're unearned revenues instead of earned, even though I've really earned them. Got the idea? We record them as though they were unearned, and then we would save them for next year. What could I do on my expenses? I just record a little extra depreciation expense, shorten the lines. Use a more accelerated method. Although we're supposed to be consistent year to year under generally accepted accounting principles, aren't we? That's one of the reasons. You can't change your method of depreciation, the lives you put on assets, or whether you're declining balance or your straight line. You can't change based on whether you have too much income or too little income. Right? You don't get to do that. You're supposed to follow the same methods all the time, right? So we watch for this kind of stuff. How about for the bad debt expense? Might I just jack it up a little bit? It'll give me less income. Next year I'll just have less. I'll have to have less next year because I've over-allowed, and when I write them off, I won't write off very much. So next year I won't write it off as much as I have in my allowance, right? So then next year I won't need as much bad debt expense. It'll work out good, won't it? Do you think people might be tempted to smooth so that they can get smooth earnings, so they can maximize their share price? What happens to borrowing? What does the bank think? How risky does the bank think it is if the income is fairly stable versus bouncing up and down? They like it stable too. We call that a low beta, right? A low beta stock. The variance of their returns, okay? The covariance of their returns really with the stock market returns, the whole market's returns. We like a low beta, right? Less risky. So they'd be lying to try to get a low beta, huh? What happens if the bank thinks you're lower risk? What happens to your interest rates? Go down. Yeah. Okay, you like that? What happens to your stock price? Goes up. The stock market doesn't expect as high returns either. Oh, so there's motivation to do this. Now, that's smoothing. What would the big bad be? It's a horrible year takeover. It exists all the time. People take over companies, right? And then they want them to look good in the future. So what do? I want next year to look good in the year after the year after. I just took over the company. I'm the new CEO, right? We bought up the stock, keep investors that work with me, maybe a hospital take over the company. Sunbeam is the famous example of this. A guy named Chainsaw Al. I can't remember Al's last name, but they called him Chainsaw Al. Because what he'd do is he'd buy companies, right? Take over companies with his group of investors, and then he'd fire a whole bunch of people, and he'd, eliminate a lot of workers, and then he'd make it look like, he'd get rid of product lines and do other things, right? He'd make it look like they were making money. One of the things he did at Sunbeam was that they Sunbeam makes appliances, right? Small appliances. They still exist. They're just owned by somebody else now, right? Because he drove them into bankruptcy the rest of the way. They were already in trouble. But he took metal parts out of vacuum cleaners and replaced them with plastic ones that melted. I'm not kidding. This was one of his strategies. He didn't mean for them to melt, right? So they had just all kinds of defective ones, and he didn't record any of the returns, right? Sales returns. Did you record those? Probably. Sales returns and allowances, reducing your net sales, reducing your income, right, guys? Okay. And when he did put them back into inventory, he put them in at full cost, even though they were worthless, all kinds of stuff like that. But what he did was the big bath is he took over the company. And guess what? He wrote up most of the accounts receivable. Debit, bad debt expense, credit allowance, right? Because they're never going to collect it. What happens if in the future years they do collect it? Oh, that's a recovery of bad debts, right? Makes your income more. The other thing he did was he wrote up a whole bunch of assets. Either depreciated a whole bunch or just wrote them off as worthless. Then what happens later when you still can use them? They're free. You don't have to depreciate it. More profit, huh? Getting the idea? You can do that with a whole lot of different things. You can do it with warranties, right? It's an estimate anyway. Debit warranty expense are a really big number, and credit warranty payable, and then when the warranties come in less in future years, you have more profit in the future years. So what you do, company after company, is make it look like they're making money when they weren't. You got rich dudes, lots of money. It exploded on Sunday, because the stock market went down and you couldn't sell the company. And it unraveled, and everybody found out what he'd done, right? He got away with it at several companies. He had to pay about $100 million of the $400 million that he sold at Sunday. That was terrible for him. He also got to go to jail for a little while, right? But anyway, that's kind of rare. Mostly they get away with it. So that's the big bath. Big bath, right? Bad year anyway. Make it really bad. Continuing management would be tempted to do it too, right? We're going to have a loss. The stock market's going to punish us. Let's write off a whole bunch of stuff, and then we'll have profits in the future, huh? Are you guys working as auditors or working inside the company, right? CPA working inside the company? Say no. Say no, say no, say no. You don't want to go down with them, right? I have quit clients and I have quit a job before. I was working for a CPA firm. I was teaching at Central University, making about $20,000 a year. Yeah, anyway, it's terrible. And I didn't have my PhD, didn't even have a master's yet. And then I made another $25,000 a year in my spare time working for a CPA firm in Yakima, Washington. So more than doubled my salary. And these guys, I was an outside independent reviewer, and I was reviewing this audit that they had done. And they says, no, I won't sign off on this. It's not okay. I'll put my signature on anything. You guys, this isn't an audit. This isn't an appropriate audit. The disclosures aren't right. All this stuff. And the managing partner of the firm is a small firm. He says, Keith, we were thinking about asking you to be a partner, but there's no way we could now. And I says, well, not only do I not want to be your partner, I don't want to be your outside independent reviewer anymore. And I walked away from over half of my income. Because they were helping clients falsify financial information. They wouldn't have viewed it that way, but they were. They were reporting more income than they had to keep the bank happy. And he was a tax practitioner at the partner. He says, no, we're on our client's side. And I says, no, we're independent, we're auditors. And even if I was on the client's side, I wouldn't lie. I hope they weren't lying in their tax return, but I have no way of knowing. You might have written off the government too. By the way, the managing partner of that firm lived in a $2 million house and drove a great big Mercedes. What do you think? Do you get away with lacking integrity? Yeah, he's retired now and he's rich. Never got called to the carpet for it. So what makes you have integrity? You. You can have it or not. Probably if you cheat and you steal, you get away with it. It's business. And you're going to know how, too. You're going to know how to embezzle every time you get out of here. What's going to keep you from doing it? These are the times that I hope there is a hell, even though I'm an agnostic. Because I hope those guys get to go there. Because we're not doing anything to them while they're alive, right? And they're in our profession. So what are you going to do in our profession? The right thing? I hope. How many of you took more than 3 hours on this exam? None of you, right? How many of you looked at the exam before you were done studying? None of you, right? If you did, please drop the class and leave Bellarmine. Go somewhere else. You can get a good education sort of somewhere else, right? Good enough. Because you're going to steal what you get anyway, right? You don't need much of an education to steal, probably, right? If you want to do it right, you get paid for what you really do, and for generating wealth out in the world, right? Out in the economy, right? Developing society and all that. Feeding people, housing people, all that stuff, right? Including yourself. Keep doing what you're doing, Tom. Okay, anyway. So I have total confidence that nobody took extra time. Don't all you guys feel that way? I hope so. Do we know? Nah. Yeah. Nobody ever will know. Wow. That's kind of the way it works, guys. What happens if they find out that you've been intentionally misstating financial statements? I said it's over. You give somebody $100,000 of your money, and they lie to you about what they do with it. What do you want? Give me my money back. So when you're talking to a president of a company, God, we got to have another penny earnings per share. You go find it. What's going to happen? I'm going to say, I'll go look. But when I look, I have to look for what? If you want a penny more earnings per share, what do you need? More income, right? You're not going to change the number of shares. Right? You do that after the fact. Okay, so how do you get more income? You search for more revenues, right? Or you search for revenues that are under-recorded, you record them. What's the other thing you do? You search for expenses that are over-recorded, right? And you lower them. Is that legitimate to do? Of course it is, but be careful. What else do you need to do? Don't do a biased search. Oh, look for expenses that are under-reported too, because there's millions of transactions. What if you only look for errors that over-recorded expense? Will you find them? Sure. Should you also look for errors that under-recorded and record those too? Yes. And probabilistically, what's probably going to happen here? They're going to offset each other. You can say, I'll look at them all if you want, millions of transactions, but I'll probably find them in our favor and against us both. The income might get worse, not better, right? Okay? And then do the revenues too. If we're looking for revenues that are understated, we're going to increase it. What else are we going to look for? Overstated, reduce them, right? I've had it several times in my career where clients, these are CPAs working for the clients, have done a selective search like that. At least I hope they did. I hope they didn't do it on purpose. So what I do, you start looking at all the adjusting entries they did, and all of them made their income look better. Now wait a minute. You guys did adjusting journal entries, and all of them made your income more. What are you doing? Is there a smoothing thing going on, or what? So what you do is you sit down, what I did, you sit down with the client and you start talking, these all seem to be going in the same direction. And real quick, you'll see all the blood drain from their face. And you don't know, right? Turn pale. And they'll say something like this, typically. Oh my God, you think we did this on purpose? Here, Keith, no, that's not what we did. Here's what we did. The boss said we had to have more income. We looked for revenues that were understated. We looked for expenses that were overstated. Oh my God, we didn't look at the other side, right? And what do you pray if you're the auditor? That they're telling you the truth, that they don't know the game, right? Because they could still be what? Just covering themselves. We did it on purpose, but I'm going to tell you it was an accident, right? I hope all of them that I found, because ultimately we didn't do anything about it, right? Other than adjust the financial statements, of course, right? But we kept the client. Should we have in every case? I don't know. It's business, you guys, right? You don't know. You're trusting people. Everybody's trusting everybody. What happens in the stock market when investors lose confidence in companies reporting? Huge crashes. What happened to the subprime loan fiasco? Huge reduction in the stock market. What happened in the Enron, WorldCom, and all that fiasco with Arthur Andersen? Destroyed Arthur Andersen, huge drop in the stock market. Investor confidence is really important. And what we're doing is we're helping them have confidence in the numbers, okay? All right. Do they tell the truth to the extent we know whatever the truth is? Of course, they're all estimates. What's the transaction approach versus the capital maintenance approach on page 162 and 163? What's capital maintenance? Transactions, recording all your transactions. That's what U.S. GAAP requires. What's capital maintenance? Down at the bottom of page 163. Always read these things, you guys. The most common alternative to transaction approach is capital maintenance. Under this approach, a company determines net income for the period based on the change in equity. Wow. So look at beginning equity, ending equity, and whatever changed must have been the income. Other than non-owner transactions, right? Where they invested. You already know this, don't you? Other than non-owner transactions. Investments by owners, withdrawals by owners, dividends to owners, right? You guys didn't read this, so just tell me. Have you ever seen those definitions there? Elements of financial statements, revenues, expenses, gains, losses? Anytime I can just throw in and give me a definition, right? You'd be comfortable with that. On page 162, what's this thing? What do the numbers mean? This is hilarious. Companies hitting the target. Companies are more likely to round up earnings per share figures to the next highest cent than to round down. No kidding. Chart shows the frequency of the digits to the tenth of a cent place for nearly 489,000 quarterly reports. I have you do this with your GPA. If your GPA, let's say your GPA, this is what companies are doing. And I don't know, it's kind of, I think it's okay with your GPA. I don't know about it for earnings, it's a little shaky maybe. But let's say you have a 3, there we go. Say you have a 3.2 5, right? Or you have a 3.22. What I'll have you do is I'll have you round this one to 3.5 or 3.3. Monkey. That's a 3.3. Let's not go to 5. That's what this is. That's a 3.3, and this one is a 3.22. People do this with numbers all the time, huh? This makes this one look like it's a lot more than that one. You can't lie here and say it's a 3.3, can you? You can round it down to 3.2, but who in their right mind could do that? Tell them it's a 3.22. Got the idea? Yeah. Well, companies kind of do the same thing, only some of them get carried away. Does $1.04 or 4 cents, does that round to $1.05? No, but they'll round it to $1.05. Really? How can you rationalize that? You can't, right? This one, though, can you round this one to $1.05? Yes. That close? Okay. And what's bad is on earnings per share, the market reacts to that earnings per share, what they expected versus what they got. They'll punish you for missing it by almost nothing. It's totally irrational. Shareholders are irrational, though. People buying and selling stocks are kind of irrational. We can tell that with the stock bounce, market bouncing all over the place. You know what? They say explain, because the Fed did not increase interest rates, the market went down the other day. But a few days before that, the market went down because the Fed said they were going to raise them. It can't go down for both reasons. You can't have it go down because they didn't raise rates and then have it go down because they did raise rates. Give me a break. We don't know why the market does what it does. It's just people's impressions of it, okay? We don't know why people invest in the companies they invest in. We don't know. They just do. And we're trying to give them information to use to make those decisions, right? Okay, anyway, so you ought to know that. All right, let's get into the components of the statements. You've seen this before, haven't you? Only now you're going to be able to do it. If I gave you a problem where I asked you to do a multi-step income statement, could you make it look like the statement on page 165? The answer at this point is probably not, but will you be able to when we do the quiz on 4 and 5? Absolutely. I might just give you a whole bunch of accounts in alphabetical order and have you give me something that looks like that. Can you do it? Typically for a company, we don't show selling expenses and administrative expenses like that. We'll put them on a supporting schedule. Now here's the deal. What do I mean by that? You can show things on the face of the balance sheet and the face of the income statement on the statement. Or you can show it parenthetically. What does that mean? You might show sales. See where they have sales revenue, less sales discounts, and sales returns and allowances? What you could do is you could put sales revenue and then put parentheses around sales discounts in the amount, sales returns and allowances in the amount, and just show the net sales, right? You show it on one line then, save space. So that's parenthetical disclosure. We do that with allowance for doubtful accounts all the time, right? You show accounts receivable net of allowance for doubtful accounts, and you show the net, right? And you tell them what the allowance is. Well, obviously you could add the allowance to the net and get the gross, couldn't you? We do that with depreciation a lot, right? Equipment net of accumulated depreciation, building net of accumulated depreciation. That's called parenthetical, right? You could also show it in the notes to the financial statements, right? You could show the depreciation in a note to the financial statements. That makes sense? Or you could show the allowance for doubtful accounts, I suppose, if you want to, in a note. Or you can do it in a supporting schedule. And that's a lot of times what we do with selling and administrative and other types of operating expenses, right? So we have a schedule for all the operating expenses, and we just have one line that says total operating expenses on the income statement. It makes the income statement a lot shorter. You can show the detail of supporting schedules. But those are, the notes and the supporting schedules are all an integral part, we say, of the financial statements. They're part of the statements. That make sense, guys? So there's flexibility in this disclosure. Anyway, is this a manufacturing business, a merchandising business, or a service business? Manufacturers manufacture product and sell it, right? Usually the merchandising firms that are then going to resell the product, right? They sell merchandise, okay? Manufacturer can also be a merchandiser. They can sell it to the general public too, right? Okay? And then what's service? They sell services. What is this one? I don't see any raw materials. I don't see any cost of goods manufactured, that sort of thing. They're not manufacturing, whatever. Somebody say merchandising? Thought I heard it. Yeah, it's a merchandising firm. How come I know it's not service? They're selling product. They have cost of goods sold. A bunch of you guys, because I showed you an example in class where there was cost of goods sold, where there was inventory, insisted on that cash to accrual thing that nobody got all the way right. Some people got fairly close. Wow. You did better on the test, didn't you? Did you learn how to do it before you took the test? Again, why didn't you learn how to do it before you did the quiz? Beats me. Human beings, I guess, right? Happens over and over, right? Now you know how, don't you? Right? You can move forward, okay? And then you're going to know how in the final two, right? No more brain dumps. Everybody agree with that? Don't forget anything you learn now. There's more to learn, right? Just keep adding, keep adding, keep adding, and keep it. So when you go out in your career, you know what you're doing. Okay, that's what we want here. This isn't just to meet a requirement for class. This is knowing what you're doing when you go to work, okay? And anyway, so I know I keep harping on that, but I just look at your quizzes, so, you know. Anyway, so yeah, you did that problem I gave you didn't have any inventory, you couldn't have had any cost of goods sold, right? You just created that out of thin air or something. Okay, anyway, so what kind of an account of sales discount, sales returns, allowances? What are they? I mean, sales is a revenue account. What are those things? Oh, come on. You don't have to read the chapter for that. What are those things? See, because you're subtracting them from sales to get net sales. Contra revenue. Yeah, they're contra revenue. So they got debit balances. Good. Okay? Your cost of goods sold, by the way, they should have a schedule for cost of goods sold, shouldn't they? What would you have for cost of goods sold? Probably is on a supporting schedule, right? I don't know why they should put that on the face of the statement or put the operating expenses somewhere else, right? On a supporting schedule. But anyway, what would you have for cost of goods sold? How do you calculate it? Yeah, cost of goods sold. How do you calculate it in an income statement? What do you have? Getting inventory plus
how much you bought.
Purchases less purchase discounts and purchase returns and allowances plus freight in, which gives me what? Beginning inventory plus the net purchases gives me what, everybody? Cost of goods available for sale. Take away what? Ending inventory, what does that give me? Cost of goods sold. I should have shown that there. to do this yet, did you? You can be there, okay, because they're gonna spend it, huh, okay? I mean, everybody knows that. I don't remember that, I just know it. When you're valuing inventory, what's gonna go into inventory? Come up with your cost of your inventory. What things did I just list as being in the cost of goods sold calculation? What's gonna be in there? What it costs you to purchase it, less what? The purchase discounts. Returns and allowances, that's a whole unit coming back, so you don't have to subtract that out. Plus what? Freight in. Is freight in part of the cost of purchasing something? Of course it is, right? I mean, in the inventory chapter, we'll talk about that a lot. Sure it is. So it's the cost of it, less purchase discounts, plus freight in, must be what the inventory costs, huh? Like costing an inventory item, yeah.
Well, what is freight in? Like what it takes to get
Oh, what's freight in versus freight out? Yeah, what's freight in? The freight to get it delivered to you, right? So I could buy the product, I could buy a product from you for $1,000 a unit, say, for some raw material or something, or some finished product, $1,000 a unit, and you pay for the freight. Or maybe I pay you $900 and I have to pay for the freight. The freight's about $100. What did I really pay for it? $1,000 either way, right? So the freight is the cost of getting it delivered to you. That's part of the cost of goods sold. What's the freight out? It's the cost of shipping it to somebody. And what would that be? That's a cost of selling it, not a cost of buying it. And therefore it is a what? Selling expense. Yeah, freight out's a selling expense. And it's common sense, isn't it? Right? So freight in and freight out are totally different things? Yeah. Freight in is part of the inventory. Freight out is a selling cost. Right? Everybody agree to that? So as you're reading this stuff, what I got to get you doing is thinking about what you're looking at. What is it? What am I doing here? What is this stuff? You don't remember everything. Even on this one page, is there too much to remember here? Yeah. Okay? It's knowing what you're doing. It's knowing where things go. So what's the difference between, we get a gross profit, then we have all our selling and administrative, and we get income from operations. Okay, income from operations. And then we have, after that, other revenues and gains and other expenses and losses. How would you describe those things? They're what to the operations? Cost of goods sold and selling and administrative expenses are all expenses. That stuff down below is something else. Dividend revenue, rent revenue. You could have gains on selling an asset, maybe equipment or building. Then losses, they have interest on bonds and notes, which I kind of like to have up under administrative expenses, because they can put it there if they want. It's some flexibility here. And you might also have, a lot, casualty loss, loss of a piece of equipment or something in an accident that wasn't insured, maybe, right? You have a loss on selling something, right? You have various expenses down there. What are those things compared? What would you say about the regular expenses up under operating expenses, cost of goods sold? And expenses, a what? It's from continuing operations, right? It's in the normal course of business, right? Normal course of business, right? The things I need to do to generate my revenues are my expenses. What are all those things down below there? They're peripheral. You already know these definitions, don't you? Use those definitions. That stuff is peripheral. Why do I think that interest expense probably, I prefer for it to be up under administrative expenses? I don't think that's peripheral. I think it's a cost of doing business, cost of your revenues. But a lot of people put it down below. By the way, when you're reading financial statements, it's important to see where they put the interest expense. Whether it's income included a reduction in or income from operations, or they put it down below. Why would people like to put it down below there? Because that's non-operating stuff, huh? So it looks like your operations are better than they really are. I think if you put the interest down there. So what would I do if I was analyzing the company? I'd move it up above and change your operating income. You can do it. They're going to disclose it, right? And it's okay to disclose it this way. But they're artificially making themselves look better, in my view. Okay? All right, guys. Anyway, you know what? You show earnings per share. This is real limited here. You show earnings per share on every item from net income on down to what? What's going to be below net income? Remember back to principles. What things do we have below net income from continuing operations? Another name for that line instead of net income is net income from continuing operations. What goes down below there? And you think of two things. Some operations are not continuing. What are they called? Cleverly. discontinue it, I did what to it? It's discontinued it. Remember that stuff? No, we just gloss over the principle something, right? You're going to get it here. Discontinued operations, huh? Okay? That'll be the first thing. And then what's the other one? It goes DE, alphabetical order, or you can remember DEC, right? For the first two, right? That works. Okay, DE, I used to use Digital Equipment Corporation, because there used to be C in there too, but we moved that over into retained earnings. You got to get down to chapter 2. Oh, man. Okay, so there's some stuff in here, new things, sort of, gloss over. Okay, discontinued operations, what else? What do you think the E is? It goes down in not from continuing operations, but it's extraordinary. Yeah, extraordinary operation. Okay, notice that the income tax expense, they call it just say income tax, right? On page 165, the income tax is there, right? Well, that's on all the revenues and expenses above, so all those are before income taxes, aren't they? Seeing as you've got net income really after tax there, and we're going to call that income from continuing operations after tax, what are we going to have to do with every item below the line? Discontinued operations and extraordinary items of course. What are we going to have to do with those? Show them all net of tax, right? Because you already showed the tax on the income statement. So let's flip on over there. Let's go back. On page 174, 175, start getting into all that stuff. Let's take a look at page 178. Have some more information here. What they've done is they've condensed in the brown box. They've condensed this income statement down a little bit, right? Operating is sales less cost of goods sold is gross profit less selling administrative comes down to income from operations. Everybody see it? They must have supporting schedules for cost of goods sold or in a note to the financial statements and for selling and administrative. Would you agree with that? On this statement, it's more condensed. Okay, and then what do we have? Other, the non-operating stuff, right? Other revenues and gains, interest revenue, other expenses and losses, loss on disposal of part of a division, loss on the sale of investments. Part of a division is not a discontinued operation, it has to be all of a division, right? To be a discontinued operation, it has to be a significant major portion of the operation. So you have to make a judgment call. Is it a discontinued operation, or is it just a gain or a loss of disposal of part of the statement, right? Okay, part of an operation. Okay, so then they got income from continuing operations before income tax. We call it that if we have things down below. Does that make sense? And then you take away your income tax expense, and you have income from continuing operations. Everything below that has to be net of tax. You need to know this, okay? So I'll be giving you problems where I give you the income before tax, and give you a tax rate, and you can calculate the income from continuing operations. So then what goes first? Discontinued operations. And you don't just show one gain or loss of discontinued operations, you'll show two things. What are they? What shows there, guys? You just read it. Reading the statement, you can see it. There's income from operating this pizza division they got rid of, right? It's a discontinued operation, less the applicable income tax of 24.8. Now here, if they have positive income, that would be a tax expense. Would you guys agree with that? So how much was the loss before taxes on that? So you can show it net, 54,000, which is how we do it. What would it be? 78.8. Yeah, 78.8. That's it. So you can calculate back into it, couldn't you? Okay? Usually we'll put parentheses around the less applicable income tax. You can call that parenthetical disclosure, even with the comments still parenthetical disclosure. Got it? So we're showing you it's a statement there, but it doesn't have its own line. Then they have a loss on the disposal. So we separate the gain or loss from operating it from the date we decide to dispose of the segment through the time we get rid of the segment. You guys with me? Because it's not normal operations. As soon as you decide you're going to get rid of something, what do you start doing? Shutting it down. Selling off their inventory, laying off their employees, giving them severance packages, retraining, right guys? You do all kinds of stuff to separate yourself from that division, right? So anything that happens in terms of revenues and expenses from the time that you make the decision to get rid of it through the disposal date, that's really part of the gain or loss on disposal. Does that make sense? So we show it. It's the first line there, okay? And then when we actually dispose of it, we'll have a gain or a loss of disposing of it. This time they have a loss. okay? Now remember, the gain or loss is compared to book value for the company. So could you have a loss on operations and a gain on disposal? It happens a lot of times. This is kind of a weird one. You have a gain from operating and a loss on disposal. Let's get rid of it, you have a gain going, right? Especially if a loss. Anyway, whatever happens here. Okay, could happen, of course. All right, notice on the loss, it says less than applicable income tax, but what do you think the loss was? And wait a minute, this is a loss of 90, and it's 41 tax. You know, up above, they have income before tax at 460, right? And this is and then we've got another, we just decided 78,800, right? Of gain from operations, of the discontinued operation. What does this loss do? It lowers our income on our tax return, doesn't it? Right? And what will happen to your taxes if you lower your income on your tax return? They'll go down. This is an income tax benefit. I'd prefer they wrote down, and I'd like to see you guys do that. It would be loss and disposal less the applicable income tax benefit. Less the income tax benefit. So my loss was how much? 90 plus 41, it was 131. And then I get a benefit, a reduction of taxes of 41 to give you a net loss of 90. Everybody got the idea? If you lower your income, you get a tax benefit, don't you? Right? Loss of lower their income. Yes, sir.
You're saying separate the two numbers, so we'll actually show 131 and then...
You don't have to do that. Some people do, but you don't have to. But what I would say is, instead of just income tax effect, applicable income tax effect, I'd say net of income tax benefit. And on the first one, I would have said net of income tax expense. Be clear about what's an expense and what's a benefit, I think is useful. Okay? All right? Then they add them together, right? Everybody got the idea? So you got income before extraordinary item now because they happen to have an extraordinary item. Of course, if they didn't have that, extraordinary item would just be net income at that point. Make sense? So you could have discontinued operations and an extraordinary item, or you could just have one or the other, or you could have neither, right? These aren't supposed to be very often, of course. Okay? To be extraordinary, what does it have to be? Two things. You're going to have to remember this for Deck. He's going to do it. He's going to make fun if you don't know it. He'll make fun of me because you don't know it. What do you think? Come on. It's a quiz question in 101. Unusual and infrequent. Both. Unusual and infrequent. What if it's only one? Now it's a non-operating item, right? You got it? Non-operating, but before continuing operations. Right, guys? Before tax. It's one or the other. It goes up above, right? Just like on the discontinued segment, it's got to be a major segment of the business. If I have, I don't know, on Lay's potato chips, I have sour cream and onion potato chips. Do they still have that stuff? Okay, sour cream and onion potato chips. I used to like those when I eat potato chips. Okay. Now I eat more expensive things that are supposed to taste, it did not taste better, be bad for you. Okay, anyway. So, still fat. Okay, anyway. So, what if they got rid of sour cream and onion potato chips? Do you think they'd get rid of a segment of their business? Really? How many other kinds of potato chips do they have? Oh, 20? I don't know. And yeah, a bunch of them, right? I don't think that's a segment. Come on. That's not a discontinued segment. What if they got rid of all their potato chips? Oh, yeah, that is. Okay? The same. But that would be a segment. Would that make sense, guys? It's got to be significant. It's got to be major. What if it's Nordstrom's, right? You guys know who Nordstrom's is? Pretty high quality clothing retail. My wife loves it. Okay. They deliver packages to my house almost every day, right? They have a free return policy. She actually buys things that she doesn't like, she just brings it back. And they want her doing that because she buys a lot from them every year, right? So it's just back and forth, back and forth. They do that instead of having a whole bunch of stores. They have fewer stores and having much cheaper. And a good deal with UPS, of course, FedEx, all those guys. Yeah. So all kinds of ways of doing business. Anyway, so they imagine what it costs to ship it back and forth. Although she pays a fortune for the stuff she buys from it. So, yes, it's worth it. But anyway, now what was I talking about? Oh, what if they got rid of men's clothes? They only have women's stuff. I think that's a segment. What if they get rid of handkerchiefs? Men's handkerchiefs goes. Nah, that's not enough. You got the idea? It's gonna be a judgment call though, isn't it? What about men's shoes? They started the shoe store, you guys. Women's shoes, that's probably just gonna keep saying. Men's? Yeah, probably stuff. Probably stuff. Right? What about socks? Probably not. I don't know, right? Judgment call. Everybody got it? Okay, and what do you do if it's just part of the segment? Above continuing operations, right? Before tax. What do you do if it's discontinued segment? It's a discontinued operation, show it net of tax. Got it? And you show both from operating it from the date you decide to get rid of it, up through the date you do get rid of it, right? That's the first line there. Income from operations, right? And then gain or loss on disposal, right? Two separate lines. One could be a gain, one a loss, both losses, both gains. And what you notice one other thing. Now after net income, what do? They do earnings per share for every single line from what's called the line down, okay? So what do we think the line is here? What's the line, gang? The line, when we refer to it, is net income after tax is the line, okay? Everything that's above the line is pre-tax. That makes sense? All the revenues are before tax. All the expenses are before tax. That includes from operations and from non-operating, right? Everybody good? Everything below the line after net income is what? Shown net of tax. Got it? So it's easy to remember. Okay? I'm going to expect you to know this stuff inside out. Okay? So we're done. Okay. Boy, you guys have some reading to do. We show another example on page 172. Income from continuing operations, the last black line there with the line. And what lasts in black, and everything below that, that's discontinued operations. In this case, only no extraordinary item. See? Earnings per share for everything below that. Okay. Everything below that is net of tax. Okay. Again. Oh, single step statements over on page 167. Usually you wouldn't do a single step statement for a merchandising firm, right? It's condensed at the top of page 167. Over on 168 is the single step. You wouldn't do single step if you were manufacturing or a merchandising firm. This would be more for service businesses. Make sense? Okay. Now this one does show sales and cost of goods sold, but it's more for service. Typically, right? Wouldn't have cost of goods sold there. And the reason is you don't have gross profit, so you don't need that line, right? Here it's kind of nice to have gross profit if you have the expenses. So that makes sense. By the way, what's the difference? We said merchandising firm versus manufacturing firm versus service business. What's the difference between retail and wholesale? Merchandising firms could be wholesale or retail, and some can manufacture for that matter. Could be wholesale or retail. What's wholesale sales versus retail sales? What's that? No, you get a discount for larger quantities typically. You get a trade discount for that. We'll look at that later in a couple of chapters. But now this is something different. It's who your customers are. Wholesale customers, who are they? Retailers, maybe another wholesaler who's going to sell it again, right? Okay? But yeah, retailers a lot of times, you're not selling to the general public, you're selling to other businesses, right? Business to business. Wholesale sales, right? What's a retail sale? Selling to general public. What's Walmart? They're a retailer, right? What's American Food Products? Have you guys ever gone to an American Food Products store? They're aren't they? They sell them to Kroger, Whole Foods, all those things. Walmart, right? Okay? Sell food, but they're not selling to the general public. They're a wholesaler. You know the difference. Okay, man. So on page 169, we already did unusual gains and losses, didn't we? An unusual gain or loss is what? It's not part of the central operations of the business, what you're in business to do, right? So it's not revenues and expenses. If I'm Ford Motor Company, it is not selling Fords, producing and selling Fords, right? That wouldn't be unusual or infrequent. What would be? Well, maybe rental income, right? Maybe gain losses on sales of building or equipment, gains on those, right? Everybody got the idea on the distinction here? Okay. How about though if you're UPS? Now you're selling Ford trucks. What's that going to be for you? That's not revenue or expense. What is it for you? Gain or loss on the sale of equipment, isn't it? So for Ford, buying or selling rather Ford trucks, right, is what? Sales revenue and all the costs associated with their operating expenses, right? Cost of goods sold or operating expenses. True? For UPS, what's their revenue? Delivering packages. What are their expenses? All the costs associated with delivering packages, right? Truck driver salaries, fuel, you name it. Depreciation on that equipment, sure. Okay? But what about selling a truck or selling an airplane? That's a non-operating, right? Gain or loss. You guys know these things, right? We did all the definitions, didn't we? Let those definitions fit the reality here, and you got it made. Okay? It's the same stuff. So those definitions weren't just for the help of office. What's that going to do when you get into 212? Cover chapter 1 and 2 again. Really, really fast. It'll give you a monster quiz. Why do we want you to know this theory so well? Because it's what you're used, right? It's what you're using all the way through, guys. Come on. Okay? Non-controlling interest we did. We did discontinued operations extraordinary. Non-controlling interest. What about a non-controlling interest? What's that? Over on page 176. Okay. Look at that little illustration. Here's for Coca-Cola. There's their consolidated net income. It's all their companies added together. That's what consolidated is, right? Consolidated balance sheets is all the companies added together. And we're going to have in 414 rather, you're going to do consolidations. It's a major part of the course. Okay? It's a real monster. It's about 2 credits of that class. Okay? We consolidate the balance sheets. We consolidate the income statements. Put them together, right? And then we can eliminate all the intercompany stuff. That's the hard stuff. Doing business with yourself, right? Remember that a little bit in principles? Did a little bit. A real simple consolidation, elimination entry we did. Okay? And then we consolidate the balance sheet, income statement, and the cash flow statements. Put them all together. Consolidated statements. This is the portion of the income that belongs to the minority shareholders. That's all that is. So you subtract their share of the income. Got it? That's all that is. Okay? So there's another line. Hopefully you get a question like that in the CPA exam. That'd be nice. What to do with it. Kind of an obscure little thing. So, but we've got it. Okay? One other thing I should mention. Over on page 171, they talk about intra-period tax allocation. So there's inter-period and intra-period. What do you think intra-period? What does intra mean versus inter? I-N-T-E-R versus I-N-T-R-A. Intra means what? Within the period. What's inter means? Between periods. So inter-period tax allocation would be which year the tax expense goes in. So for deferred income tax, we'll be using that, right? We're figuring out which tax belongs in which particular calendar year, okay? Or quarter or whatever it is, or maybe even a month, okay? That's inter-period. Where does the tax income go, therefore where's the tax go? Okay? What's intra-period? Throughout the income statement and also the retained earnings statement, where do you put the taxes? What does it belong on? Does it belong, and what places could it be so far in the income statement? You have net income before tax, right guys? Or you have income from continuing operations before tax. Same thing. You only call it net income if there are no extraordinary items and no discontinued operations, right? So anyway, if you have income from continuing operations before tax, some of the taxes have to go with that. That's all we're talking about. So we allocate some of it to that, okay? Then what do? We allocate some of it to discontinued operations, right? And we allocate some of it to extraordinary items. We're also going to have cumulative effect of a change in accounting principle and prior period adjustments we might allocate some to, and those will both be in retained earnings, okay? So there could be other places where we allocate. So you ought to know what that is. Read these really carefully and think about what they mean, right? You guys aren't very good at that yet, are you? You can see it in your test scores, can't you? Quiz scores. Right? Get better at it. You said 20 hours last weekend? How many of you gave me 20 hours over the weekend? 3 of you? Over 15, I hope? Yeah. What should you be doing every week? Preparing for a career here, what should you do? 20 hours a week, man. Can you do it? Can you do 4 hours a day, 5 days a week for this class? The answer is yes. up some of your sleep. No problem. You want to be real successful? How would you feel if Pricewaterhouse or EY, when you are in November, it's going to be November soon, right? By the time they make their job offers, now it's they're interviewing right now. Some people will be getting offers from them. Actually, at the end of your sophomore year, you guys sophomores? Any freshmen? That's normal. Okay. At the end of this year, you go to summer leadership with these firms, and at the end of summer leadership, if you're impressing and you have a really good GPA so far, like this class and next class, a couple other accounting classes, right? If you have a really nice GPA and you go to their summer leadership, you apply for it, you go to it, you may have a full-time internship offer with a Big Four firm at the end of the summer. I'm not kidding. If you don't, in the fall, you'll be interviewing for those jobs. I'm not kidding. The internships are going to pay $15,000 to $25,000 depending on how many hours you work for one semester. I'm kidding. And then they're going to hire you at the end of your full-time internship, most likely, to do a really good job. They're going to give you $55,000. They just said that raises are salaries are increasing right now. It's going to be around $55,000 maybe. Then you're going to have the job offer in January, December, January through June of the year. Our salary will double in 5 to 7 years. Double again in another 5 to 7. So are you willing to give me 20 hours? Will it pay off? And if you don't want a Big Four job, you know what? The Big Four would hire you, so will everybody else on earth. All of them. Got it? Everybody. Every firm, every company. Everybody will win. And you don't have to have a 4.0. You can have a 3.3 or a 3.4 out of this place. Okay? Right? Same with the finance, you guys. And remember, I told you this, didn't I? If you are a finance major, you say, I'm never going to be a CPA, I dare you to survive Brad Stevenson and Dan Bauer, who will be back from the sabbatical next semester, right? I dare you to survive them without doing well in this and 212 and 313. It will not happen. You won't do well. You know why? Because you're going to be competing with people who got A's and B's out of me and out of debt and out of trade. Everybody's got the idea here? Right? It's a real competitive environment here, okay? And guess what all those brokerage firms out there want, and all those banks want, all those investment firms want? A really nice GPA. What do they have to measure you with when you go to work? How many of you have a whole bunch of experience in finance right now? None of you. What are they going to use to measure whether or not you're any good? How you did on these stupid quizzes and tests, okay? This is real time now, you guys. I know you're young, but this is real time. By the way, if you completely wipe out now, does that mean your career is over? Of course not. You can do all kinds of things. We have a whole lot. Who's a certificate student? Okay? Did you do something else before?
Like major-wise?
Yeah.
Economics.
You have a college degree in economics, right? How come you're doing this?
I just didn't want to pursue that route.
Yeah, you'd have to go get a PhD to get a good job. It's true, isn't it? This is faster, isn't it? And it pays really well. It's okay, and it's fun too. It's all right. That's not a bad track. By the way, econ accounting, wonderful again. Wonderful. So that's good. What did you do?
Business.
Business. Why are you here?
So I can eventually have my own business one day and
Yeah.
become tax preparer.
Maybe make more money.
Yeah.
Maybe have a stable career.
Yeah.
And maybe, do more. Big deal. You can do it anytime, you guys. Right? Did you have fun when you got your business degree?
I did.
Oh, I'm glad. Right? Yeah. How old are you now?
29.
29. How old are you? 19. Where are you going to be 10 years from now? Sitting in his classroom with him? Oh, he won't be here anymore. He's going to be a partner somewhere, right? Okay. What are you going to be? Partner somewhere. He's going to be a partner at 29. You're going to be a partner at 39. Who cares? It doesn't make any difference. In the end, we all die anyway, guys. I'm sorry, right? But it's all right. It doesn't matter when you do it. But you can do it that way. Why am I suggesting that to these young folks?
Do it now.
Do it now. Yeah, do it now. Do it now. Do it now. You're not as old as you went straight through, and now you're doing more, right? Did I have you in principles once or something? No, listen. Okay. Where'd you have your principles at?
UK.
That's good. They do good job. They're fine. You're probably doing okay. By the way, you guys, I do not know what your scores were on the quizzes. I won't know what your scores are on the test. I won't remember what your grade is in this class unless you ask me for a recommendation. Did I tell you that? I'll be happy to give you one. Don't ask me for one if you get a T, okay? Right? But if you get a C plus or above, absolutely, I'll give you a recommendation. That's a good grade. There are a whole bunch of people working big four firms out there that got a C plus for me. Okay? It's all right. Now, I don't want you to do that, but if you wipe out on this first test, maybe C plus is all you can get up to, right? Some of you are going to wipe out. Don't give up. Keep doing it. What's the very worst thing that can happen to you? Take it again. Get it right. Move forward. Acton. What's Acton's first name? You guys know him? The student here? James. James Acton just sent me an email asking me to let him know some addresses for YouTubes so he can look up YouTubes and listen to this nonsense that you're doing here. Why did he do that, you suppose? Not as well as he wished he had, I guess, right? He talked to Richard Straight, and Richard says, why don't you just ask me for the YouTube thing that you could listen to at home whenever you want? You know, after you're done working all week, right? You could sit and listen to those things, right? I bet he's trying to pass the CPA exam. What do you think? Is the CPA exam automatic, you guys? 1/3 of the people who take each part pass it each time. 2/3 fail. What happens with felony students? You guys pass. You're welcome. So all this work I'm getting you to do right now, it's going to get you through the CPA exam. It's going to get you a job. It's going to get you through the CPA exam. Who would you rather have work for you? Somebody who studied for the CPA exam or somebody who passed it? 22 years old, right? In your case, 30, I guess, right? Be soon. Okay? How old you're going to be? 23. Okay, whatever. All right? What's the deal going to be, you guys? When I went to work, I had passed 3 parts. I had 1 part left. Managing partner had, not managing partner, partner had me come to his office. That's our training center. Had me come in and sit down. He says, Pete, seems like you're doing fine here. I've never seen you before in my life. Just look at my file. He says, looks like you're doing fine on your jobs. What's your plan for passing the CPA exam? And I said, well, before I started work, I passed 3 parts. That's right, I've been there 6 months. I passed 3 parts, and I did the last part right when I came back from the staff training for auditing, and I passed that too, so I passed all 4 parts. He says, good, you're on my jobs. Welcome to the profession. Bye. Now you know what? They give you a $5,000 or $6,000 bonus because you passed. Don't they? We got 0. Nothing. Earn it, right? It's a big deal. You pass the exam. You know what? Everybody passes the CPA exam. It's a CPA firm. If you're interviewing for a job later in your career in finance or accounting, if you want to be a financial vice president and you don't have CPA next to your name, you go in the round file. You know what the round file is, right? That one's not round, but there's one right over there. Okay, yeah. Everybody else has a CPA, you don't. What are they going to do with it? Throw you away. Okay? So if you don't want to work in public accounting, should you take the CPA exam? Well, only if you want money. Right? Yeah, I can see you guys. Get to work. Read the chapter. What's wrong with you people? I'm kidding. It's all right. I know you meant to read it. Get to work. Did I put this one out there? Anybody really want to listen to this? Well, maybe you would. I did talk about stuff, didn't I? I guess we'll see.